You have 1,500 of ordinary loss, and you have 4,000 of capital gain, Jesse. That's it. And that's true of A too. This now gets split 50-50, agreed? Plus, Yolanda, right, you have 15,000 of ordinary income in addition as a guaranteed payment. All right. So everyone see this, that the partnership gets to deduct the guaranteed payment because Nancy would say it doesn't have to be capitalized, or we're told that. This is 3,000 ordinary loss, 8,000 capital gain, 50-50 partners split it. Done. That's what your notes should indicate. All right, question B. What results in A if A services relate to improvements on land owned by the partnership? All right, Angie, what's going to happen there? You're going to have to capitalize that, right? The guaranteed payment has to be capitalized. Now, does A still have to report the income, Oceana? Yes, right? That's the gains case. A still has to report the income, right? A still has to report the income, but aside from that, since that has to be capitalized, there's still 12,000 of ordinary income, 8,000 of capital gain that gets split 50-50. That's it. That's the difference in outcome. So, any question?
Yeah.
Go ahead.
Okay. The last answer didn't quite get it.
The last answer is there's a $15,000 guaranteed payment to A. It has to take ordinary income. It has to be capitalized under Code Section 263, and that keeps this intact.
The 12,000?
Yep.
So that was split equally between the parties.
That's it.
A's outside basis would also go up by that guaranteed payment.
Absolutely. A's basis goes up by 15 in guaranteed payment.
Partnership caps it and does what with it?
I'm sorry?
Like, what does the partnership do with that capitalized amount in year two?
It's depreciated. It depends on if it has a useful life or if it's tied to something like land.
Okay.
Okay, we need to know more. Now, question C is going to be what separates those who know and those who don't know. So take 2 minutes. And this is straight from the regulations. It's straight from that 1969 revenue ruling. Without me opening up my mouth. Take 2 minutes. Try to come up with numbers. What's the guaranteed payment? And what would end up with the partners? I'll try to stop. This is straight from a mark from your notes. This is 707-1C, example 2. I'll repeat, 707-1C, example 2, and revenue ruling 69-180. Okay, so try to work it out. All right, so anyone think they've got this? Amber, you got a big smile. I don't know if there's any. Just say it loudly. You weren't smiling.
No, I was, but at something else.
Just in general? You want to give it a try?
Yeah. Okay.
Go ahead. What's the guaranteed payment here?
So the problem is that before you take the guaranteed payment, it's 50% of the profit. So if the profit is 20.
Okay, the profit's
that
20. 20, 50% of 20 is 10, right?
Right, so then the payment is the 15 minus the 10, so the guarantee is 5.
Okay, everybody agree? The guaranteed under the regulations as they're written now is 5. Why? Because the person says, listen, I get 50% or 15,000, right? I must get at least 15,000. Here, 50% of the profits, right, is 10. I'm still missing 5. So the guaranteed payment must be 5. Okay?
And it doesn't matter that part of the income is ordinary and part is not.
Doesn't matter. Okay? So the guaranteed payment here is 5. Now, that means that the ordinary income portion now has been reduced from 12 down to 7, right? How much does A need now financially, now that we've decided the guaranteed payment is 5? How much does A need? There's now 15,000, right? Everyone agree? There's 15,000. How much does A need? 10. So, with respect to each one of these payments, 10/15 times 7 and 10/15 times 8 is going to be A's distributive share.
What's 7 and 8?
What?
What's 7 and 8 with their interest?
7, this is ordinary income. It started at 12, but the guaranteed payment reduced it to 7, right? 12 minus 5 is 7. The capital gain stayed at 8. And we know with the 15, 10, let's go to A. So 10/15 times 7. So when you total this all up, 5 plus this will equal 15. Everyone agree? And B is going to get the balance, right? So Jesse, in this case, if you role play B, you would be taxed on $2,333 of ordinary income, and your capital gain would be $2,667. All right? Straight from the regulations, guys. Straight from the revenue ruling. There's, again, nothing was changed really, but for some of the number variations. But it really is plug it in, and you'll come up with this answer. So what are you going to do, Lamar, when you get a chance? You're going to read example 2. Okay? You can read all the examples, but this example 2, that's this problem in a nutshell. Notice the next question D, says, how would your answer change under the proposed regulations? So again, here's Heraclitus suggesting that the world will change. Is that, Amar, you were going to say before I go on? Go ahead, Amar. Amber.
So for the exam, this is just for A, right?
No, this is for problem C.
No, partner A.
Right.
Partner A, yes.
So are you going to ask us to do partner B as well, the other?
Yeah, I gave you the answer verbally. I said what happened to
Oh,
me.
sorry. Blank that.
You blanked out, but do you want me to repeat that then?
No. It's okay.
Amber, for you, I'll repeat it.
No, it's okay. It's okay.
You're okay. Okay?
Oh, if somebody didn't get it, then sure.
What was that, Amber?
Okay.
Betty, you okay?
Yeah, just go ahead and repeat it. We'll do that anyway.
All right. Partner B has to take $2,333 into ordinary income and also has $2,667 in capital gain. Okay? Now, how does the world change in problem D? Under the proposed regulations, proposed regulations say, heck, partner A demanded 50% or 15,000. You know what? 15,000 is the guaranteed payment here. And would take the position somewhat simplified here that A would have a guaranteed payment of 15,000, and we know what would happen then. The ordinary income would be -3. Everyone agree? We've been there. That's just like we did in problem A. And the proposed regulations mimic and simplify and to say, you know what? The whole thing's a guaranteed payment, and it would be very similar to the outcome in A. Okay? The 15,000 would be fully deductible, assuming it didn't have to be capitalized, right, Angie? And you would just take the 3,000 of ordinary loss and the $8,000 in capital gain and then split it 50-50. All right, you guys have been patient. Why don't we take our nine-minute break now, and we'll pick up right here, okay? Thanks for giving me the extra time. Let's pick up exactly where we left off. Again, problem 1, replication of the examples under the regulations. And that's what all these are. Question 2, G, cash method taxpayers and 1/3 partner in FGH, accrual method. G is employed by the partnership and is entitled to a guaranteed payment of $10,000 for year 1. G's outside basis during that year 1 is 0. G's agreement with the partnership specifies he will receive the $10,000 guaranteed payment on June 1st of year 3. On January 1st of year 2, partnership sells an asset with a basis and fair market value of 15, puts section 1001. There's no gain, right? They just get $15,000 in cash. Everyone agree? It distributes $5,000 cash to each partner. And what is this problem designed to illustrate, guys?
That G's basis is going to go up even though it doesn't have cash?
Well, G's basis tries to raise what the gains case did. Does a partner have an outside basis? Will their outside basis go up by 5? Okay, so if you get a cash distribution, your outside basis is 5. There's no income, right? Conversely, there are commentators, and you can look in the material in our textbook, who argue that you only have a $5,000 basis in your guaranteed payment, separate and apart from the partnership. Sort of like you treat that as its own intangible. And if that were true, where you had a $5,000 basis in this guaranteed payment, your outside basis in the partnership would not go up. Everybody agree? And if you got a cash distribution of 5 and your outside basis was 0, guess what? You'd have $5,000 of income, right? So the authors are trying to play with you a little bit, but not play with you in a malicious fashion, just trying to say this issue is still unresolved. The gains case suggests that your outside basis would go up, but there is some ambiguity here. All right, so for your notes, I'm not trying to be cryptic. I'm not trying to be equivocal. The answer is, I think the better answer is your outside basis goes up and there'd be no gain, but just want you to be aware you would want to warn a client that this is not a resolved area. The IRS could argue that your basis and the guaranteed payment goes up by 5, and the distribution could trigger income. Amber, were you going to say something?
Can you say that last sentence?
Right. In the latter case, you have a $5,000 basis in the guaranteed payment, not your partnership, and therefore the distribution could trigger income. And we'll get to distribution soon enough. Question 3. This situation is similar to that of Revenue Ruling 69-180. Is it possible for amounts to be paid to a partner in excess of guaranteed payments to be classified as a 707A1 payment? I mean, anything's possible. And what does that mean by anything's possible? Meaning, remember in that problem, the first 5,000 was guaranteed payment, agreed? And the second 1,000 was a distributive share, agreed? And usually distributive shares are paid in your capacity as a partner, agreed? But for your notes, this could be a 707A2A disguised payment, right? It could. I'm not saying it is. It could be some sort of disguised payment. If it's a disguised payment under code section 707A2A, how do you treat it? You treat it as a 707A payment, right? A1 payment. So, for your notes, it's theoretically possible. Question 4. Partner renders services worth $10,000 to partnership, which he is a partner. Without regard to partner's services, partnership has $75,000 of ordinary income and $25,000 of long-term capital gain. All right? Both the partner and partnership are calendar year taxpayers, but partner uses the cash method of accounting. Partnership uses the accrual method. Partnership does not make the payment to a partner during the year, but where it's permitted, it accrues the expense. Okay? And this is deductible. Code section 263 would not apply here, right? Deductible under 162. Determine the tax consequences of the following alternative transactions to the partner and partnership. In recognition of his services, partners allocate the first $10,000 of partnership profits, which are treated part of his distributive share. Okay? So how would the partner be treated here? How would you guys treat this?
The services are in partner capacity or not?
They are in capacity of partners. So this is considered a distributive share, not a guaranteed payment, right? He renders services, but he's not guaranteed that, right? And he says, gee, guys, I'm working hard. Pay me an extra 10. It's going to be a distributive share. How would the partner pick up this income, this 10,000? Say again, Joe?
It just sounds like it'd be normally part of it. Hang on, words. Just flow it through and pick it up as distributive income, right?
And what does that mean here?
As in, it's...
What's the character?
You probably split it, 3/4 ordinary and then 1/4 capital.
Okay, hear me on this. It's distributive share, and notice it's 10%, right? There's $100,000 of income, right? $75,000 is ordinary, $25,000 is capital gain, right? Everyone agree? And here the person says, gee, I'm getting 10,000 of that. 75% is going to be ordinary income, or 7,500 ordinary income. 2,500 is going to be capital gain of that 10,000, right? Everyone agree? He's going to get the first $10,000 here of the distributive share. Okay? And that means the remaining 67,500 and the remaining 22,500 is going to be allocated however the partners, if it's 50-50, however they decide. The point the authors want to call to your attention by way of contrast is this is just plain vanilla distributive share, right? This is not a 707A1 payment. This is not a guaranteed payment under code section 707C. Just plain vanilla distributive share. And do not, if you don't mind me saying, people's inclination is, oh, this is all ordinary income, right, Dill? That you might have thought that initially, but then you paused and you said, gee, distributive share is going to take the flavor of the income in proportion to the partnership income, the kind of income that was earned by the partnership. Okay? So your notes have that? Question B. Section 707A1 applies because the services are unrelated to the everyday conduct of the partnership activities and are not continuous. So what would be the tax implications in year one? What are the authors trying to illustrate here? Mohammed, what are they trying to illustrate?
There would be ordinary income to the partner and a deduction to the partner.
Is that what it's trying to illustrate? We said in question B that it's a 707A1, right? It's not, so that is ordinary income, but the question is, what happens in year one?
It's not
Not deductible, right? Because it's not income to him because he's a cash method taxpayer, right? And the partnership can't accrue the deduction under Code Section 267A2, right? That being the case, the partnership has $75,000 of ordinary income, $25,000 of capital gain to be divided accordingly. So in year one, that's what happens. The partners get taxed on $100,000. Agreed? In year two, right, Mohammed, then the deduction would come into play. And it would be all deductible from ordinary income, assuming it was deductible. But I think they said it was. Okay, so the authors in question B are just trying to illustrate, don't forget the limitations, right, under 267A2. Question C. Code Section 707C applies because the services are ongoing services related to the partnership activities but are paid without regard. So there's a $10,000 guaranteed payment. Okay? So what happens here? Tina. Not sure? Mariana? I'm sorry? Guaranteed payment deductible? It's going to be deductible. Is it ordinary income to our taxpayer?
Yes.
It's ordinary income, right? To our taxpayer, right? So here, assuming it's ordinary income to the taxpayer, it's deductible to the by the partnership, right? Because does the partner have to accrue it in income even though cash method taxpayer, even if the taxpayer doesn't get paid? Yes, right? It's determined in accordance with the partnerships, right? Alicia, it's taxable year. So even if the cash method taxpayer doesn't get paid, right, Eric, still has to take it into income, right? And that would reduce ordinary income from 75 down to 65, right? So it would be 65 of ordinary income left and 25 of capital gains to divvy up. All right. Question D. Partners allocate $10,000, which is treated under 707A2A as a 701 payment. So it's a disguised payment. That being the case, where does that get us back to? Gets us back to the identical results in question B. right?
Or the partnership can't deduct it.
The partnership can't deduct it, right, Mohammed, because of Code Section 267A2. All right, so the first segment, guys, of the chapter is dealing with these kind of payments to a partner, right? And it deals with the three different kinds, right? As a non-partner, guaranteed payment, and distributed share. Beginning on page 232, is a discussion of partnership interest, or partnership interest issued with respect to services rendered, okay? Partnership interest issued with respect to services rendered. Now, bear in mind, and I said this before the exam, this segment of the book used to be in chapter 2. For better or worse, in this segment, if you guys have an earlier edition, this used to be in chapter 2. It has been moved in this edition here. Now, I don't know if that's good or bad, but I pointed out, and I think it's important even the first or second week of class to make an observation. When a partner, there forms a partnership or a new person comes on board, performs services, they can be issued one of two kinds of interest. A so-called capital interest or a profits interest, okay? One or the other. What is a capital interest? You know how we spent several weeks looking at capital accounts? A capital account signifies that you have a vested economic interest in that partnership, agreed? That represents your economic stake in the enterprise. That is a capital interest. By way of contrast, a profits interest simply means, fingers crossed, going forward, you're going to make money, or the partnership's going to make money, right? And your capital account is a big goose egg, right? Notice the difference. And in general, as I explained to you before the exam, making generalities, generally the receipt of a capital interest, you feel richer, and that's usually a benchmark for taxability, as we know under Code Section 61. Not surprisingly, in the sphere of partnerships, likewise. You get issued a capital interest, generally taxable. Conversely, you get issued a profits interest, sort of like getting a lottery ticket, right? You don't have to report anything unless you had your numbers hit, right? Well, that's the equivalent of a profits interest, right? The numbers hit, you got to take it into income. But if they don't, you don't. All right? So the authors make this distinction between a capital interest and a profits interest. And the first part of this segment of the chapter, not surprising, this part of the chapter is divided into two parts, right? It's bifurcated in half. First it looks at the capital interest, then it looks at the profits interest. And with respect to the capital interest, beginning on page 233, starts with a very simple statement. A service partner who receives the capital interest realizes ordinary income in an amount equal to the value of the interest received, less the amount, if any, paid for the interest. Code Section 83 is a code section that comes up a little bit in income tax. It comes up here in partnership tax. Essentially says if there's the risk of forfeiture, you don't have to take accretions into wealth, into income until there's no longer a risk of forfeiture. We don't want to tax you on phantom income. Congress is saying, no tax on what may be phantom income. If you have a risk of losing something, we're not going to tax you today, because if we tax you today and you subsequently lose it, you may have to ask for a refund, and there's all sorts of issues. So Congress is ready, willing, and able, under Code Section 83, to defer taxability until the risk of forfeiture disappears. That's Code Section 83A. However, there's many taxpayers who want to, I know this sounds shocking, take it into income today. And there's something called an 83B election, where notwithstanding the risk, you can take it into income today. And why would partners make an 83B election? And let me also point out, they're fairly popular. So, Jenny, why would anyone take this in, make an 83B election?
Because they make an election, and in the later days, whatever the interest will be appreciated, and the difference will be treated as not taxable.
All right, so they make an 83B election because they're optimistic. They're optimistic that if they take it into income today, whatever the value is, let's say 10,000, their aspirations are when it vests, say when it's worth 100,000, they'll only have, by making an 83B election, they'll be taxed at 10,000, because once it vests, there's no subsequent tax implications. So by making the tax election today, they bear a burden of tax of $10,000. If and when it vests and the interest, say, hypothetically is worth 100,000, then they avoid the difference of that $90,000 appreciation. So what's the downside risk of making the election, Jenny?
It's depreciated.
If subsequently you forfeit it, you cannot get a loss. Okay? Everyone agree? So you've got to warn your client, everything's good until it isn't. All right? So 83B is not without a price tag, because if your client makes this election, they run the risk that subsequently they will not be able to secure a loss. Go ahead.
Isn't it a capital loss if it goes down?
Well, first of all, if they forfeit it,
Okay.
they forfeit it, and they do not get a loss. Okay? I think if you were referring to if they make an 83B election, take 10,000, they subsequently sell it for 7,500, then they can get a
Yeah,
loss.
that's what I'm referring to.
Okay. So the authors describe on page 234, the first full paragraph, what is an 83B election. And the authors describe on page 235, the first full paragraph, what, again, Heraclitus would say is a changing river, potentially a changing river. If we know with respect to Keenan, and we learned with respect to guaranteed payments, if you use appreciated property to satisfy a debt, right, that triggers a gain. Everyone agree? Use of appreciated property to satisfy a debt, in many contexts, triggers a gain. Suppose Fusto performs services for the partnership, and Tamara and Dill are partners, and they're going to pay Fusto a 10% interest in the partnership, and the partnership has a building worth $100,000 with a basis of $10,000, right? And Fusto's going to get a 10% interest. The existing law suggests that their use of that property, where they're going to give away 10% to Fusto, constitutes a recognition event, and that they would have to pay 10% of the building is worth how much? $10,000. right? 10% of 100,000. And 10% of the basis of 10,000 is 1,000. And they would have to recognize a $9,000 gain, the partnership would, allocable to Dill and Tamara. All right? So not only would Fusto have income, and we're going to have the visual, because he performed services in return for this capital interest worth $10,000, but the partners who use equivalently an appreciated asset would likewise have a gain in this. And we'll see. Fusto will be deemed to have contributed that 10% interest back to the partnership. So the partnership now will have, excuse me, a building that will be considered two buildings. One building with worth 90,000 with a basis of 9, and another building which will be fair market value of 10 with a basis of 10, right? Because it's as if Fusto contributed that appreciated portion of the building. So if you picture a 10-story building, it's as if Fusto is contributing the 10th floor, if you have the visual. And the first 9 floors have remained the same.
Can they just revalue the building before they give 10% Fusto and recognize 90% gain?
But that's what they did. They recognized gain on.
I mean 90,000 gain.
They don't want to recognize 90,000
They
gain.
don't.
Last I checked, taxpayers don't like. They want to recognize the least possible. Now, my point too is the new regulations, the promulgated regulations suggest that it should be a non-taxable event. The new regulations suggest that that should be a non-taxable event. We'll talk about that in a moment. All right. We have a case which is somewhat well known, the McDougal case. Beginning on page 236. I don't know. Anyone here? Two related questions. One, I should say three. Did you read the case? Two, do you like horse racing? And three, did you understand the case? I guess. I don't know. Anyone into horse racing who said, "Gee, this really captured their imagination"? Ellie, are you a horse racer? Even if you're not, did you have a chance to look at this? Not yet. Okay. Anyone? Lisa? Jen, did you? No? Anyone? Any volunteers out there? You get to hear my monologue. Karen, you didn't?
I did read it. I thought it was the trainer for the horse.
Okay. That was the trainer. I get it. And
The horse had, like, I guess it had, like, good breeding, I guess, background.
well, at first the horse looked like a no pun. How's the phraseology? Looked like gonna be good for dog food.
No, because it had good, the genetics or whatever.
The genetics, but originally.
And then he had something wrong with his foot, but then this guy said he could get the.
Okay, I get it. Right. There's nothing wrong with the horse's foot. The horse doesn't look like it's going to move much.
I'm not going to go to race.
And this trainer thinks, no. I have a home formula.
Yeah.
I can make miracles happen. And this horse is much better than people think. And does what, Karen?
So they keep the horse and he.
He encourages these people to put up $10,000 to buy iron card, right?
Yeah. And then they said, like, afterwards, now that he did get the horse racing and stuff, they said once they recouped their expenses, then they would, like, give him half of it as a payout, I guess.
Right. In other words, we'll go, assuming we'll put up the money, we'll buy the horse once we, assuming you're right with your home brew, and we make money and we recoup our expenses, we're going to go into business together. Okay, everyone have the visual? So if you don't mind, I encourage Karen, who's a good horse trainer. I say, Karen, look, I'll put up the money. I got the money. You don't have the money. I'll put it up. I trust your word. I'll put up the 10 grand. I get my money back. Then we're 50-50, right? And I will give you a 1/2 interest in the horse, right? I paid 10,000, and the horse at the time I break even is worth how much? 60, okay? The horse, at the time, Karen and I were gonna shake hands on this. I mean, we shook hands earlier, but technically we don't become partners until I break even when the horse is worth 60, right? Okay, so at that point, the horse is worth 60, and partnership is found. And Karen, do you have income at that point? That's not the case. Remember,
Yeah.
it's not. That's not what this case addresses. Okay, that's not. But let us not forget that there are implications to the partner and to the partnership. So, Karen, do you have income?
Yes, yeah, you have the appreciated horse.
Yeah, I mean you're getting paid 30,000, right?
Well, not really, I guess it's getting, okay, and then,
All right, so everyone agree? Karen's being paid. She renders services, right? And as a result of rendering these services, she's getting 1/2 of a horse, right? Sounds like the Godfather. Okay? She's getting more than just a head. So she gets 1/2 the horse worth $30,000. Does she have income? Sure. What kind of income? Ordinary income. Everyone agree? And Code Section 83, we don't have to really worry about. There's no risk of forfeiture, right, Karen? You're not nervous. I can't take away your interest, right? There's, it's fait accompli, right? We'd have to worry about Code Section 83 had there been a risk of forfeiture, and then Karen could always have made an 83B election. Okay, but that's not the issue du jour, right, Karen? What's the issue that this case looks at?
I think that the couple just deducted it as a business expense, because that's what they were doing, it's on horse racing, of what they paid him for the partnership. And the IRS didn't like that, but then I guess they did get allowed to take it after they.
Okay, they do allow. Ultimately, the court does allow a $30,000 deduction, payment for services. Angie, there's no capitalization here. 162, they deem that. But what else do they deem? So the partnership does get a deduction, but what else does the court deem? Well, they're going to get depreciation, but page 239, that's not the issue. The second full paragraph, page 239, says, the contributing obligor will recognize gain on the transaction to the extent that the value of the undivided interest which he is deemed to have transferred exceeds his basis therein. So in other words, if you transfer $30,000 worth of horse, and your basis essentially is $5,000, we're ignoring depreciation for a moment, just keeping it simple, right? They originally paid $10,000, 1/2 of $10,000 is $5,000. Everybody agree? That they would have to recognize $25,000. So yes, they get a deduction for $30,000, but they also have. And what kind of asset is the horse? 1231 assets. Not capitalized. But there could be some recapture income, so everyone's thinking 1245, right? Like the way you think. What was that, Dale?
I believe a horse is 3-year property, depending on its use.
I don't know its class like for a horse.
This explanation was very convoluted.
Which
I didn't
explanation?
understand it. I read this, I even highlighted it. I did not understand what they were
All
trying
right.
to say.
I mean, Alicia, notwithstanding that it's somewhat hard to follow, at the end of the day, the takeaway here is not complicated, right? That the partnership gets a deduction, but because it's using an appreciated assets to fulfill an obligation, there is also this potential recognized gain. Okay. In the material that follows the McDougal case, The authors give us some practical advice, and then they get us to a problem on page 242. The FC is offered a capital interest in the partnership whose sole asset is a commercial building with a fair market value of 150, just basis of 90. Okay, so there's 60,000 of appreciation. The building has been depreciated on a straight line method. They each have a $45,000 outside basis. And C is going to come along and perform management services. Okay. What are the tax consequences to C and the partnership? In year one, C receives a 1/10 interest in the partnership as compensation for his management services. And no tricks here, guys. Does C have income, guys? And if so, how much? $15,000. Everybody agree? C has ordinary income of $15,000. That's just under 721-1B1. Regulation 721-1B1. Contribution of services to a partnership does not qualify under Code Section 721. Now, what are the consequences to A and B? $3,000 gain apiece. Now let's go slowly. First of all, they get to deduct, right? $15,000, right? Everyone agree? Right? And last I checked, what's their outside basis, guys? 45,000 apiece, right? A and B. And they get to deduct 7,500 apiece, right? But we also know under McDougal, and I'll give you a regulation, 83-6B, both McDougal and 83-6B, that the partnership has to recognize $6,000 a gain. How's that? 10% of the building, which has a fair market value of 15, right? Everyone agree? $150,000 building. 10% of that is 15. What's 10% of the basis? 9. So what's 15 minus 9? $6,000 gain, right? What does that do to basis? Increase or decrease, guys? Increase it, right? So what's their outside basis now? 40,500. And as I suggested to you, there's a building, 90%. There's a building, 10%. And adjusted basis, fair market value for A, B, and C. Their outside basis is 40,500, 40,500. And for C, it's 15,000, right? And 67,500, 67,500, and 15,000. This is is their book account. I should say book account. Book. And then with respect to the building, it's 81,135 as the 90%. Now, if the building were subsequently sold for 150, who picks up the $54,000 worth of gain? A and B, right? In this case, right? Because this is the flip side of 704C. I'll give you, believe it or not, and I know you believe it, we looked at this before the midterm. It's Regulation 704-1B5, example 14, 1 little I and 4 little I. I'll repeat. 704-1B5, example 14, 1 little I, and example 4 little I. Go ahead, Larry.
The 3,000 gain,
Yeah.
any impact on the capital account?
No.
Increase the tax.
Increase outside basis doesn't affect capital account. Okay?
That's the gain for the partnership.
Think about that, Larry. Not going to affect the book value. Now, let's just play around with this some more. And look at question B. What resulted in an A above if C receives his capital interest in exchange for legal services performed with the acquisition of the building? Okay, what are the authors alluding to? Angie, you were going to say? You got to capitalize it. Everybody agree? So it's not deductible. The $15,000, you got to treat it as an acquisition cost, right? And therefore, we're going to actually have, again, C has ordinary income of $15,000, right? Right? C has ordinary income of $15,000. A and B each have a gain of $3,000, right? And we have another chart here that's very similar. So now we have a building 90%, we have a building 10%, and then we have a acquisition, okay, expense that has to be capitalized, right? Because it's non-deductible, so it's capitalized.
Do you restart depreciation on that 10% of the building, or do you just continue?
I would restart. You got it. It's a new.
So it's another 39-year life for
Another 39-year life.
or whatever it might be.
So their basis is going to go up from 45 to 48. That's +3. And since there's no deduction here, okay, the authors are just trying to illustrate what happens if there's no deduction. Nothing fancy. Question C. What results in A above? Okay. If C receives his interest as compensation for services to be rendered in the succeeding 3 years, provided, however, that if C ceases to render the services before the end of year 3, C or any transferee of C must relinquish his interest, and assume for this problem that the building will have a value of $450 and an adjusted basis at 90 at the end of year 3. So what happens if C makes an 83B election? Go ahead.
He gets taxed on the 15,000.
Yeah, just the same thing as we did in problem A. Everyone agree? He's going to be taxed on the 15,000. And if that's true, again, the same results as in problem A. What happens, and if there's a forfeiture, he doesn't get the loss if he makes an 83B election. What happens if he doesn't make an 83B election? Without getting into too much detail, how much income is C going to be taxed on? Is he, how much income, Eric? Initially 0, but what happens when it vests?
Whatever the value, percentage value of that 450.
Oh, you know it. You don't have to say you're not sure. 10% of 450 is how much?
45.
45. He taxed on 45. Right, Eric? Everyone agree? He taxed on 45. And how much recognition would the partnership have? Say again? What's the amount realized? 45. What's the basis?
9.
9. Everybody agree? The basis here would be 9. So there would be a $36 recognition event, or $18,000 a piece. Without getting too fancy here, so for your notes. So what would their outside basis be and why? What would A and B's outside basis be? 40,500. Why? That's 45 plus 18 minus 22.5. I'll repeat. It's 45 plus 18 minus 22.5.
That's half of the 45.
What was that?
So that's half of the 45. I was trying to figure out where the 25 came from.
Half of the
Sorry.
45, which, because remember, the partnership gets a deduction of 45,000. One half of that is 22.5. It also has to recognize 36,000 of income. One half of that is 18. Again, just so people don't get lost, where do they get the 40.5? It's 45 plus 18. The 18 is one half of the $36 worth of gain. That's where you got the 18. Minus 22.5. That's 1/2 of the deduction of 45. That's where we got the 40.5. Let's start off with an outside basis. We said a 45, right? Each have an outside basis of 45. Plus they have to recognize the gain minus the deduction. Where did I get the 202.5? That starts off with 75. Plus we have to adjust because there's a new partner, so we book it up by 1/2 of the appreciation, right? Didn't it appreciate $300,000, right? The property went from 150 up to 450. So we booked it up, went up by total 1/2 of 300, which is 150. Minus 22.5, that's the 10% of the building. So that's where we got 202.5. All right, so when you're trying to figure those numbers out at home, again, this is the outside basis, this is the book value, where those numbers came from. All right, the good news is, receive a profits interest. That's the second part, last segment of this chapter. It's far easier. Because in general, 99.9% of the time, there's no effect. So beginning on the discussion, on page 242, the authors make that point, and if you don't mind me saying, what carries a lot of weight is this Hale decision. And the Hale decision comes down to one sentence, it comes down to one footnote, it comes down to footnote 3. Take a look at footnote 3. It's on page 243. Under the regulations, the mere receipt of a partnership interest in future profits does not create any tax liability, period.
Policy thing, or is that more of economic situation?
It's a practical answer, because if you do tax someone under profits interest, what do you do when the partnership subsequently does make money? Is it a return to capital, or should they be taxed again? It's not clear. So, and how do you value it, right? Think about it. How do you value the right to future profits? Very hard. Everyone agree? How do you put a number to that? Capital interest, we can value. Everyone agree? Someone gets a 10% interest in a building. Not too hard to value, right? The same cannot be said with a profits interest. And then, as they say, along came Saul Diamond. And this case rocked the boat. Because here, someone did receive a profits interest. This case, Alicia, if you had a chance to read it, is even more fun or harder to read than the McDougal case in some form or fashion. Here, someone receives a profits interest. And unlike many profits interests, this one, they got it and they subsequently sold it. So we know the fair market value, right? There's no secret to the fair market value of this. And not surprisingly, like many taxpayers, they want capital gain treatment. And the IRS is saying, no, 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 no. You received a profits interest. We know it's worth $40,000, that's what you sold it for. And what should be the character of the income? Ordinary, everyone agree? The ordinary. And there's a lot of discussion in this case, and subsequent to this case, like, is this person even really a partner? But putting that aside and treating this person as a partner, you can see the court struggle. The court struggles with this and it's not sure how it should rule. It's not often courts do this. They say, gee, if you haven't read this case, on page 248, 249, they go through and they say, what have commentators said about this? In italics. They say, what have courts said under judicial interpretation? Not good. What about the legislative history? Well, that's equivocal. And then administrative interpretation. They go through. They talk about principles of practice. But at the end of the day, the court here under Saul Diamond says it's going to defer to the commissioner. And if the commissioner says it should be treated as ordinary income and taxable immediately, so be it. Okay? So if you picture, obviously this case goes down, or comes about many years before many of you were born, but that unnerves practitioners and taxpayers because most were under the impression a profits interest is not taxable, and all of a sudden, here you have a case right in front, smack dab saying it is. Well, even the service knew that was kind of radical. Without getting into all the water under the bridge, it subsequently issues, and for your purposes, this is very important, Revenue Procedure 93-27. This revenue procedure essentially says, you know what? Not taxable. Even though we won in Saul Diamond, we're not going to pursue this. If you look at the top of page 254, it says a profits interest will only be taxable in very, 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 did I say very, very narrow circumstances. If the profits interest related to certain, substantially certain and predictable stream of income, or within 2 years of receipt, the partner disposes of the profits interest, or the profits interest is a limited partnership interest on a publicly traded, in a publicly traded partnership. Not going to happen, right, guys? 99.9% of the profits interest you deal with will not meet one of these three disjunctive conditions, right? This is not conjunctive, meaning you don't have to meet all three conditions. All you have to do is meet one of the three, right? And it will be subject to tax.
At the risk of being a dopey question, what exactly do you mean subject to tax? You mean the sale of it, or?
No, the value of it.
The receipt, okay.
The receipt of it will be subject to tax. All right? So be forewarned that, but again, when I say be forewarned, not going to happen too often, right, guys? Not going to, it's not going to meet these conditions too often. All right. So what we will do next class, guys, is we will finish. These problems are very easy. Generally, if you have to guess, not taxable, okay? Very easy. Not going to take us, and we're going to be done with this chapter within 10 minutes, okay? So, chapter 8, we will definitely finish. It is a very short chapter. So, if you don't mind reading up to page 302, that would be terrific. We will embark on a new area, okay? Very exciting. I will see everyone next Wednesday, okay?